We are firmly in earnings season, and in the past week and a half, we have got some massive earnings reports. In today's video, we're going to dive into each of these reports, but also give you my reaction and my rating on the stocks as they currently sit right now. The stocks we're going to cover in today's video include the likes of Alphabet, Amazon, Apple, ASML, Microsoft, Meta Platforms, and Tesla. So we're going to quickly go through each of these reports, but also give you my reaction on where the stocks sit right now. But before we dive in, do me a huge favor. Simply click that like button down below, as I really appreciate it, and it really truly helps with the growth of this channel. And please consider subscribing. And with that being said, let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now, completely free. All right, let's jump back into our video where we're going to take a look at some key earnings reports. And let me tell you this, based on a macro environment, looking at the economy, thank goodness for AI. The AI spending that's going around the globe is seemingly keeping this economy intact. So speaking of that, let's begin with some key AI contributors with the first stock we're going to take a peek at, which is Alphabet, stock ticker GOOGL. And this is a great spot to start because from my portfolio's perspective, this is my single largest individual stock holding within my portfolio. And when we dive into their earnings report, we could see the company beat on both the top and bottom line. Here's a look at the one-page report we put together for stocks we track over at the Stock Investor's Edge, which you can check out a link down in the description below. The company reported revenues of $96.4 billion. Those were up 14% year over year. EPS came in at $2.31 per share. Those were up 22% year over year. And when we take a peek at this fiscal.ai chart, we can see the purple line showing over the past 12 months, EPS has grown by 16.5% over the trailing 12 months. And when we dive deeper into the earnings, we can see segments such as YouTube advertising revenue coming in at $9.8 billion, just shy of $10 billion, easily beating analyst expectations. Google Cloud increased up to $13.6 billion, beating analyst estimates. And then traffic acquisition costs came in at $14.7, also beating analyst expectations. AI is obviously a huge growth driver for the company, but two segments I continue to watch very closely when it comes to Alphabet is cloud and YouTube revenue and operating income. So after reporting earnings, the very next day, the stock ended up only roughly 1%. With that report, I was hoping for a little more, but I think I know what the problem was. In the press release, management also notified investors that they would be increasing their capital expenditures budget, which was already above expectations last quarter at $75 billion. They increased it another $10 billion to $85 billion for their current fiscal year. Now if we transition over to the valuation to see are shares still worthy of a buy at current levels. And when we look at the PE ratio on a forward-looking basis, shares trade at just 19.3 times, below the company's 5-year average of 21.5 times. EV to EBITDA sits at 16.4, also below their 5-year average of 17.9 times. So definitely looking cheap here. And when it comes to my rating, I rate shares of Google, or Alphabet I should say, a strong buy. It's the cheapest of the Mag 7 stocks, and it's not really all that close. They are growing revenues while also growing margins. Two things I love seeing move simultaneously higher. And the next stock we're going to dive into is going to be Amazon, stock ticker AMZN. We went from one of my largest, or my single largest holding in my portfolio, to another top 5 holding in my portfolio in Amazon. And they reported a pretty solid quarter. The company beat on both top and bottom line. And looking here at our one-page report from the Stock Investor's Edge, we could see revenues came in at $167.7 billion, up 13% year over year. EPS came in at $1.68, up 33% year over year. Diving into the details a little more, we could see AWS revenue grew to $30.9 billion, up 18% year over year. Operating cash flow was up 12% year over year. Capital expenditures over $100 billion over the trailing 12 months now, and operating margins are sitting at 11.4%. However, after the report, Amazon shares got clobbered, down more than 8% the very next trading day. What was this related to? Well, the numbers were good, but it goes back to my saying, it's less about what you did for me and more about what you're going to do for me from an investor's standpoint, from a business standpoint. Your earnings were solid, but what are you going to do moving forward? And the guidance the company gave was a little bleak. So the guidance was one thing that spooked investors. The other was the growth rate in AWS. AWS grew 18%, which normally would be like, okay, that was pretty decent. But when you compare it to the likes of Alphabet and Microsoft, which we're going to see here in a second, it was lagging, meaning they were losing market share. And when it comes to Microsoft, they grew cloud 39% year over year. When it comes to Alphabet, they grew at a 32% clip when focusing on cloud. AWS, the largest, only 18%. Again though, when it comes to Amazon, this is a very long-term play, and I look at these dips as buying opportunities, especially as we get closer to that $200 level. They're going through a transition right now, pouring in tons of investments, which we're seeing operating cash flows increase, revenues increase, and margins increase. You could poke holes in any report out there, but the growth is there. Let's see if the valuation makes sense. One of the key metrics I like to take a peek at when looking at Amazon is their EV to EBITDA. And as you can see on your screen, over the past 5 years, the stock is traded at an EV to EBITDA multiple of around 23.2 times. As right now, shares trade at just 17.2 times. So when it comes to my rating, I rate shares of Amazon a buy. If shares get closer to $200 or below, I would rate them a strong buy. And that leads us to our next stock, which is going to be Apple, stock ticker AAPL. And this is breaking news right now, folks. Apple actually showed growth. Over the past few years, if you've been tracking Apple from revenue, net income, there's really been zero growth. And investors have been asking themselves, why should I be paying a premium with the likes of a Microsoft or Amazon and things like that when I'm getting no growth? Those companies are showing growth. Why would I pay the same price for a company with little to no growth? However, the company turned back the clocks in the latest report, which was released Thursday evening. And here's a look at our one-page report from the Stock Investor's Edge. As you can see, revenues came in at $94.0 billion. That was an increase of 10% year over year. Yes, you are seeing that correctly, double-digit growth. EPS came in at $1.57, which was 12% year over year growth. Here's a look at the top-line revenue growth, or lack thereof, over the past few years, with the company still lagging below its pandemic highs. And here's a look at the company's revenue by segment. iPhone sales still dominate, and the company made some commentary around this that there was some pull forward in sales with customers trying to beat tariffs and a possible iPhone price hike, as iPhone sales increased 13% during the quarter. Heck, I was one of those people. And then services revenue, which is the yellow bar, surpassed $100 billion and now accounts for roughly 26% of total company revenues. Here's a look at the segment revenues compared to analyst expectations. As you can see, iPhone beat, Mac revenue beat, iPad was a big miss, other products also a miss, but services beat and the gross margins beat handily. The major concern over the past few years when it comes to Apple is really a lack of innovation, as well as their non-committal to AI. They haven't really been spending on AI. They have to a degree, but there's really nothing to show for it. And when it comes to this company in particular, a company sitting on more than $130 billion of cash, this is a company in dire need of an acquisition. Let's take a fresh look at valuation, where shares currently trade at a forward PE multiple of 28.5 times. This is above the company's 5-year average of 27 times. EV to EBITDA is showing that shares are fairly valued at 22.1 times, pretty much in line with their 5-year average of 22.6 times. So valuation looks more compelling than when I sold the stock at the beginning of the year, which has proven to be the right move with the stock down more than 15% year to date. For now though, I would rate shares a hold because we did have a lot of pull forward in iPhone and Mac sales trying to beat tariffs. So I want to take a wait and see approach to see, is that going to be a continuation or was that a one-time event? So let's continue on with the next stock, continuing with this A theme. We've looked at Alphabet and Amazon and Apple. Let's take a peek at ASML, which actually reported a few weeks ago, but it's a key clog within this big AI race. They make huge lithography machines that make the most powerful and fastest high-speed semiconductor chips. Companies all over the world have tried to replicate the technology that ASML has, and they have set themselves apart. And investing in ASML is yet another way to diversify into AI. You can pick the chip designers like the NVIDIAs and AMD of the world. You can go to the manufacturers, which is going to be the likes of a Taiwan Semi. You can go the real estate route with data centers, things like Equinix, or you can go with the machine makers in a company like ASML. The company reported their Q2 earnings, as I mentioned a few weeks ago, that beat on both the top and bottom lines. Since the company reported earnings 2 weeks ago, shares are down roughly 15%. Popular investing firm Evercore ISI came out with a note saying the drop in ASML shares is a buying opportunity. And I tend to agree. I put my money where my mouth is because, as you can see, I put a trade alert out for all of my Edge Plus subscribers, notifying them of me buying the stock on the day it dropped. A key metric that I like to look at when looking at a manufacturing company like ASML is going to be their backlog or net bookings. These are orders that have been placed, but the company hasn't built the actual product and delivered it yet. The company reported net bookings of 5.5 billion euros compared to analyst expectations of 4.2 billion euros. And the company has also been deploying capital to buy back their shares at a more aggressive pace. However, there are still some risk when it comes to ASML. They are not a US-based company. They're a Dutch company, and they do have a lot of international exposure, with 25% of revenues accounting for Chinese sales. Right now, from a valuation perspective, shares trade at a forward PE multiple of 26.6 times, well below their 5-year average of 34.4 times. EV to EBITDA sits at 19.3 times, well below their 5-year average of 33.1. So when it comes to my rating, I rate shares of ASML as a buy. It's relatively cheap, a key AI clog, but there are also macro risks present. Now that we've gotten those companies that start with A out of the way, let's look at a few other key earnings reports, beginning with Microsoft, stock ticker MSFT. And of all of the companies we have looked at so far, Microsoft had the best, far and away, earnings report of those companies. Again, as I noted, so far. And one of the reasons I love Microsoft is they are such an important business to this entire global economy. They're a diversified business who continues to grow and also take revenue share. They're diversified into, obviously, AI, cloud, subscription, gaming, cyber, and the list goes on. The company reported their Q4 earnings that easily beat on both the top and bottom lines. Revenues came in at $76.4 billion, growing 18% year over year. EPS grew 24% to $3.65 per share. The stock climbed 4% the day after the report, but was up as much as 8% after hours initially. Cloud revenue grew 26% to nearly $30 billion, and Azure specifically grew 39% year over year, much faster than that 18% growth rate we saw from Amazon's AWS. Operating income grew 23% to $34.3 billion. After hours on the earnings reaction, Microsoft joined the $4 trillion club, joining the likes of NVIDIA. And over the past 12 months, shares of Microsoft have grown roughly 25%. Another area that Microsoft has been very strong at over the years is returning money to shareholders via dividends and buybacks. They don't pay a huge yield, so a lot of it has come by way of buybacks. And in the quarter, the company, or management I should say, spent over $9 billion returning money to shareholders. So all of this sounds great, but is it too late to buy the stock? Let's take a peek at valuation, where the forward PE currently sits at 34 times flat. This is above their 5-year average of 30.1 times. EV to EBITDA trade at 24.1 times, which is also above the company's 5-year average of 22.8 times. So when it comes to my rating, I'm not looking to buy any new shares of Microsoft here. So I have to rate the stock a hold, even though I'm actually tempted to take some profits at these levels. Now we're going to move on to Meta Platforms, stock ticker Meta. And as I just mentioned a second ago, with Microsoft being the best report so far, this is the best report on the list. They blew away expectations, and investors rewarded the company. This is a company that has seemingly gone all in with AI, and it's paying off in terms of growth and efficiency. The company reported their Q2 earnings that easily beat on both the top and bottom line. Revenues grew to $47.5 billion, growing 22% year over year. EPS grew to $7.14, growing 38%. Meta easily growing at a faster clip than what we saw just with Microsoft. Shares of Meta shot up more than 10% after reporting their earnings, and this was even in the face of the greater S&P 500 bleeding off into the end of that day, and it was backed by big volume. When we see big moves in stocks, I want to see them backed by volume. That is a more compelling argument. Looking back at the one-pager, we can see that advertising revenue grew 21% year over year to $46.6 billion. Operating income grew to $20.4 billion, growing 38% year over year. The company also bought back nearly $10 billion in stock. So earnings were fantastic, but the key thing to focus on with a company like Meta or Alphabet or Microsoft is going to be with capital expenditures. These are companies that have been spending billions upon billions of CapEx, mostly towards AI. So when we saw Alphabet numbers, they rose their forecast by $10 billion to $85 billion. But Meta largely kept their forecast the same, just raising the low end of their range, as they plan to spend between $66 and $72 billion, whereas the low end used to be $64 billion. In addition, the company gave upbeat guidance for the third quarter as well. So again, you can see a very solid quarter. Looking at the results in the past, looking at the results moving forward, our CapEx hasn't blown up or anything like that. A great report for the likes of Meta. And the thing to look at is when we have capital expenditures nearing $100 billion, as investors, we want to know, are these paying off? And the way to see that is usually through margin expansion and continued growth. Two things we continue to see with Meta. Taking a look here, you can see that since 2020, revenues have increased from $85.9 billion to $178.8 billion over the trailing 12 months. Operating margins over that period have increased from 38% to 44% over the trailing 12 months. So after the 10% move in shares, are they too expensive? Well, one thing let's get straight. I don't like chasing stocks, and a 10% move is a big one-day move. Looking at valuations here, you could see that the forward PE multiples at 26.7 times, well above their 5-year average of 21.1. EV to EBITDA is at 19.7, well above their 5-year average of 15.8. But at the same time, this is a very different company today than they were 5 years. So I would expect these to be this high, and I would say this is more like a company that's fairly valued rather than being overvalued. So when it comes to my rating, again, I'm not looking to buy any new shares here, so I have to rate the stock a hold, even though, like Microsoft, I am tempted to take some profits at these levels if, in fact, I had a sizable position. And now we're going to move to the final stock we're going to take a peek at, which is going to be Tesla. And I can't say I saved the best for last. In fact, it's probably the worst for last. And when it comes to Tesla, this report was nowhere near any of the reports that we just looked at. Seemingly, it's always the same message. When you're investing in Tesla, you can't look at traditional valuation metrics, and you can't listen to a management team that's going to guide you in the right direction. Tesla investors are purely investing on hope. Hope for a cheaper car, hope for AI, hope for robotics, hope for self-driving. At some point, the actual results need to start coming in. And the actual results right now, to put it lightly, they suck. Here's a look at our one-pager we put together for Tesla. As you can see, revenues came in at $22.5 billion, which beat analysts' expectations, but were down 12% year over year. Earnings per share came in at 40 cents, which were in line with expectations, and those were down 23% year over year. Automotive revenues fell 16%, energy revenues fell 7%, total deliveries fell 13%, operating income down 42%, and operating cash flow down 30%. I would love for someone in the comments down below to tell me anything positive from this report, because it's the same story. What management is going to do and what Elon is going to do. Again, one of the best innovators of our very age right here, okay? So not going to take anything away from him. But what they constantly do is turn your attention away from the results and turn towards hope. And any number that they give you of when cheaper cars are coming, when robotics are coming, when robotaxis are coming, just add 6 months to 6 years. So speaking of robotaxis, right now, Waymo is way ahead. And I know with people that just love Tesla, you can't really tell them anything, but facts are facts. Tesla has about 24 robotaxis out there. Waymo is in the thousands, okay? But the thing with Tesla is I do believe that they can scale this much faster, and they can get to profitability much faster as well. The cost of building a car for Tesla compared to building a Waymo car is much, much cheaper. So again, if you want to invest in hope, you definitely can. I'm not saying this company is going to zero. It is going to continue to be volatile. So when it comes to my rating, I have to rate shares of Tesla a sell. These are not shares that I want in my portfolio. Now, don't get me wrong, I do love trading options on Tesla. The premiums are very juicy, and the volatility is perfect for that. So if you can stand the volatility, then definitely options is a great route. And if you want to follow any of my Tesla option trades, then become a subscriber to our Options Edge Plus, where everything is focused and discussed around the topic of options and generating cash flow. So there we just looked at a number of high quality key companies in the S&P 500, some of the largest companies in the S&P 500. Down in the comments below, I want you to let me know which of these stocks would you rate a buy today. Let me know down in the comment section, as I do try to read all of the comments and, yes, try to get rid of as much spam as I can as well. So thank you guys so much for watching the entirety of this video. If you haven't done so yet, just please hit that like button down below. It takes less than a second to do, but it really helps me and shows your appreciation for the videos that we put out. So thank you guys for the support, and we'll see you in the next one. Take care.